Hey, hello everyone. My name is John Cash. I'm the CEO of URG. We are an in-situ uranium miner located in Wyoming. We have our Lost Creek project up and running, and our Shirley Basin project is our second project that's permit ready. And it's an exciting time in the uranium space. Things are moving north on pricing, and the contracting is at a great place.
That it is, John, that it is. You weren't able to make it over here. A couple of colleagues were for the WNA here in London. The vibe is buzzing. People are excited. Utilities are in attendance, and I think meaningful conversations are being had. But look, I wanted to catch up with you. You've been your share price has been on a tear since we last met, hockey stick type fashion. Few things I want to talk about. I do want to talk about the macro. I want to talk about, obviously what you're up to, but you just put out your Q2 numbers. Let's kind of just highlight some of those things, because I think there's some important elements in there which help drive the business forward too. So if you don't mind. Yeah,
just a few highlights from the quarterly. First off, the cash position. We still have a very good, strong cash position, $63.7 million as of the last quarter. So that's seeing us through ramp up at Lost Creek. So we're in a good position there. Also, we've got a really good inventory remaining, and it's 100% produced at Lost Creek, about 224,000 pounds. So today's spot price of $61, that's worth a lot of money, and that's immediately saleable if and when we want to be able to do that. So we're in a good cash position. Our contract book has continued to grow. We've got 3 really good, high-priced, long-term contracts. All of them were signed well north of the spot price and the long-term price when we signed them. They're all base price escalated. And in total, they're worth about 3.75 million pounds, plus or minus a little bit of flex. But all of those are with major companies, nuclear companies around the world. And so that's put us in a really good place where we're going to start seeing revenues from those this year. And they go for a total of 6 years. And we're looking to sign more contracts going forward. We're also ramping up production at Lost Creek to sell into those contracts, and that's coming along. Header House 2-4 is our first new header house that's up and running. We've got really good flow there. Very pleased with that. And we expect to be bringing on another header house probably in about 2 weeks. And we'll try to bring on one new header house every month and a half thereafter until we take our flow rate up to 6,000 gallons a minute. And we'll produce enough to sell into those contracts. Anything above and beyond that, we'll hold as inventory. Maybe we'll sell a little bit into the spot if and when that becomes advantageous. But no, we're really happy with where we are and our ability to ramp up, and we're working hard to maintain that low-cost reputation that we've gotten over the years.
Yeah, and then sometimes it's about timing the market perfectly. And from everything I'm hearing here at the WNA and from some of the companies in attendance and some industry players, companies that are able to get back into production soon will be the beneficiaries. I think it seems to be the message that we're hearing. But my slight concern over some of the conversations is the fact that it feels like not everyone who's been talking the game of being able to get back into production will get back into production in the time frame that they've indicated, because they're going to need higher and higher incentive price. And if indeed they technically can get out of the ground. So for someone like you, you're obviously cognizant of that. And with your two projects, you've got your contracts. So can you take advantage of this? Do you feel that, given the conversations you've had to date with contracts you've signed and conversations you're having about future contracts, the market understands that perhaps the pounds won't necessarily all be there when they're needed?
Yeah, I think the market may be only just starting to come to that realization, especially after Cameco's announcement over the weekend about some of their struggles at their mines bringing those online. I can appreciate those struggles. They're real. Getting manpower, I've been very open. That's been a struggle for us. We're where we need to be right now, but we still need to hire a few more going into the future for Lost Creek. Equipment availability, building out, inflationary pressures. Those things are all very real. I can tell you from firsthand experience in ramping up Lost Creek. And I don't think we're unique. That's going to be true in North America and around the world. So, yeah, there are a lot of companies that they're going to struggle to get into production. We're in an enviable position at Lost Creek in that we already had all of our electrical equipment, supplies we needed. Well, we were looking a long ways into the future. But I've also been very open with the public that when we make the decision to ramp up Shirley Basin, because that's a new facility, we're going to be exposed to more of those challenges at Shirley Basin than we are at Lost Creek. We could build out Shirley Basin in 6 months and start up production if we had all the supplies and people on the ground ready to go. But that's not the case. So now we're saying 24 months to be able to build that out and ramp it up. That's a big difference between 6 and 24 months. But that's the reality that we and other uranium miners globally are going to face right now. And we're in a friendly jurisdiction. We're probably in one of the easiest jurisdictions globally, but we still face those challenges. And I think the market is just now beginning to realize that and start to discount some of those pounds.
Yeah, and I guess most investors will be looking and go, well, that scarcity usually drives price, which may drive incentive. So maybe a kind of circular fashion. It may allow the sector to get to where it needs to be because we want everyone to be successful, obviously. But as you say, mining is tough, and some people have the skill sets and access to not just moving parts, but the people to do that. For a company like yourself, you're very close to that kind of that revenue that you're forecasting. You said to me in the past, you're not going to get carried away. You want to focus on what you've got and not get carried away with M&A. But M&A is inevitable here. We've seen lots of zombie projects spring up. By that, I mean projects which didn't work the last 2 or 3 cycles, and miraculously, they're expected to work this time around. Does that surprise you? Do you think we will see more M&A, whether or not you're going to participate in yourself?
Yeah, I think that's inevitable. Given where the market's going, you're going to see more cash flowing into the space from hedge funds and other investors. It's going to make more sense to do M&A going forward, grow companies, grow the production portfolio, and try to de-risk by going into different jurisdictions. So yeah, that's going to be a consequence of the increasing market. As far as our company goes, we'll do what's best for our shareholders. That's what we're here to do. And we're aggressively looking for acquisition to grow the company. Again, sticking with our thesis of only picking up valuable, mineable projects. We don't want junk. But there may be somebody that comes in our door and knocks on our door, and we'll listen to what they have to say. And ultimately, the decision will be in the interest of our shareholders.
But you're not discounting it then. Okay, sorry, I was referencing back to something you said previously. Okay, so not discounting completely out of hand. Then in which case, you're obviously putting and I guess the buyers and people putting contracts together are assigning a lot of value on people who are actually able to get into production. Not talk about pounds on the ground, but get pounds in the ground, out of the ground, into the can, right? That's where. Do you believe that producers will probably start seeing more of that leverage that has been exclusively the domain of explorers, for instance? I mean, what does it look like going forward for you?
Oh yeah, no, absolutely. In our conversations with utilities, which we have frequently, they're indicating that they want diversity. They want pounds from proven mines, from safe jurisdictions. So the contracts we've been signing, as I indicated earlier, they're at escalated prices, much higher than at the spot or the long-term price when we signed those contracts. So
explain what that means, because I had a great conversation with a fuel buyer yesterday, and we talked about the different types of contracting terms and agreements and movables in there. So you've done what type of contracts, and why does that mean that you're not being penalized for going too early?
Yeah, so we wanted to lock in good revenues. Keep in mind that the 3 contracts we've signed, they've been signed late last year into early this year. So keep in mind where the spot price was during that time. But they are a fixed price that escalates essentially based on an inflation provision, so we can remain profitable and inflation doesn't pass up the value of the uranium. And that's the way we've established the first 3. We wanted to lock in that good, stable revenue at prices that we knew would be profitable for the mine, and we were able to do that. they were all, I would say, anywhere from $3 or $4 a pound higher to maybe as high as $10 a pound higher than what the spot price was when we signed those contracts. And that's what I mean by that they were at escalated pricing. And that's a reflection of companies recognized that we've been a low-cost historic producer, and they had faith that we could get back into production and be a reliable supplier of those pounds. And I don't think everybody is going to be able to say that going forward. But our strategy on our contract book is changing a little bit as we're seeing a more frothy market. We want to maintain some exposure to those elevated prices as they move upward. So our contract book going forward, our preference would be something that is market linked. It may be two different pricing mechanisms, where maybe one is base price escalated and another component that would be escalated with market, always with floor protections. And I think historically, miners weren't always able to get that or ask for that because it was a buyer's market, not a seller's market. But now in our conversations with utilities, it's turned into a seller's market, and we can ask for that protection, and they are receptive to that conversation. So that's kind of our strategy going forward. Have a nice mix of base price escalated, but also additional contracts that escalate with price with protection on the floor.
It's interesting. You make an interesting point. It's something we discussed, I think, yesterday with a group, which is this transition. It's kind of moving from this buyer's market, which has been for a long time, as to much of the frustration of investors for the last 4 or 5 years, and the companies for the last 10, 12 years, through to the seller's market, where you can. And I think, we've seen some CEOs quite forthright, including yourself, saying we are not moving until we've got a price that incentivizes us to move. We don't have to. We're not going to. Now it feels like you're being listened to. It is serious now. The market, the stock charts are going green across the board, with news out of places like Niger. Obviously, Kamiko's news has helped, and then a slew of other events over the past couple of years. Do you feel that the price will move quicker as a result? Because we talked about potentially the lack of actual pounds being produced, not being committed, but actually being produced. We've talked about there are not many companies currently out there who've got the money to actually do it anytime soon. So we've got a delivery delay as well, even when people say yes, let's go. So again, it comes back to you. Like, how do you play that? How do you take advantage of that in terms of your discussions, your leverage versus what has been a high leverage buyer's market up until now?
Yeah, it's a difficult conversation. We're always trying to thread that needle of when do you jump in with production? When do you jump in with contracting? Are we too early? The strategy that some companies have of we're not going to go into production. We're going to let that price continue to go higher, and we'll jump in later. That's not a bad strategy. It's a gamble either way, depending on how you look at it. We're able to jump in a little bit sooner than others at UR Energy because of our cost of production is so low compared to a number of our peers. So we can jump in now and have exceptionally good profit margins where others may have to wait a little bit longer. One of the challenges, though, with waiting on that contract book or selling, hey, we'll just sell into the spot market, is it is difficult to ramp up a mine even in good times. And now I wouldn't say we're in good times globally. The cost of money is high, labor is difficult, materials are in short supply, permitting is difficult. So to say, hey, I'll just turn the switch on and make money in the spot, that's pretty challenging because it takes a lot of time to ramp up. Even the most advanced projects take time to ramp up. And in that time that a company is ramping up, that market may have dissolved or softened. And so it kind of leaves you in a position where you spent a lot of money making pounds, but then you don't have a home for those pounds. So our strategy has been to go ahead and jump in because we've got good profit margins on those contracts. Excuse me. And we're going to work hard to keep our prices, our cost of production as low as we possibly can. But to your earlier point, there are a lot of companies out there. In fact, I'm getting ready for a conference in Washington here in a couple of months where I'll be talking about just global uranium production. And I came up with a list of what I believe I can say with a straight face are legitimate projects that have the opportunity to get in production and say in the next 8 years or so. Globally, there are only about 18. They range in size from probably annual production of 800,000 pounds a year, upwards of 20 million plus pounds per year. But if you add up all of the capacities and you say everything goes perfectly for those companies, they get the permits, they get the financing, they get the people, the contracts that they need, you're only looking at maybe 90 million pounds of production. I think the reality is over the next 8 or 10 years, the production portfolio is only going to grow by maybe 40 million pounds because a lot of those projects are brownfield projects. The cherry's been picked. The best resources have been mined. Their costs are going to be higher, not lower than they were in the past. So it's a tough time. A lot more needs to be put into exploration to grow the portfolio globally for the industry. So that's really the tough position we're in right now. But I think that's going to drive prices higher. It has to. I don't think there's any other alternative. Prices are going to have to go higher to be able to incentivize that exploration and that development for the higher cost projects going forward.
Hey, that's a slightly terrifying message you're signaling to the market there. Because if you've done the analysis and you talk about 18 companies, and if everything goes perfectly, they over the next eight years may be able to deliver 90 million. But the reality is, it's mining, it's tough, things go wrong, licenses don't get allocated, technical issues, people, money, markets, you name it. Things go wrong. It's a much, much lower number. And are you talking about new pounds on top of what the existing pounds?
Right, new pounds. And that's an annual number that I'm giving, roughly 90 million pounds, new pounds going forward from 18 projects globally.
Right. And the clip presumably ramped up in some way, shape, or form because they're not all current producers. Okay, so that's a scary number given the demand numbers that we've been seeing. And I was looking at the nuclear fuel report. The demand numbers are insane. So it kind of feels like there's well, from next year we're saying there will be inventory gaps with some of the utilities. We're saying within the next 3 years there will be a deficit. And there's not too much mobile inventory to mop up anymore. We talked about the kind of enriched supply at the moment is well, there's desolate scenes out there at the moment. It seems that's a terrifying picture. What happens? Clearly, it's going to drive price up for sure. I wonder what it's going to do to geopolitics. We mentioned Niger recently. Does that open things up for Chinese who've been mopping up uranium in Africa for a long time? What's it going to do? Russia. Can Europe get back in there? What's it do for the US? Who are going to? You'll be one of the biggest producers in the US. They're going to have to get it from somewhere. So, what's going to happen out there geopolitically?
Yeah, I think it's already had a major impact on geopolitics. Take a look at Russia, Ukraine. Russia is the big refiner of uranium. And so the Western world has been very reluctant to sanction Russia on nuclear fuel. They've sanctioned Russia on virtually everything else, but they won't touch and can't touch nuclear fuel. That's been a really difficult conversation. Maybe we eventually get there. The U.S. Congress is looking at a sanction. They may take that back up this fall. But my goodness, we're well over a year now into this conflict, and we've not found a solution to replace that supply yet. So it's already having an impact on geopolitics. And I think countries around the world have recognized, hey, if I can capture that supply, that puts me in a really powerful position when it comes to energy supply globally. And you know what? If you control energy supply, you control a lot. Nations have to have that. Politicians recognize that, hey, if I want to get reelected, I've got to have cheap energy for my constituents. And if I don't, I'm out of office. And that's true globally. So it's going to continue to have a major impact on geopolitics going forward. It's such a small industry. I've heard that the total market cap of publicly traded companies is about 40 billion. I'll have to go back and verify that number, add up some of the market caps, but roughly 40 billion, that's nothing. And it's very easy to control that by state-owned enterprises who have the backing of their governments.
Yeah, well, I think if you double, treble, quadruple that number, it's still a small number compared to technology companies. I think Apple's bigger than that by some distance. Okay, but I guess I've got to keep coming back. Your investors want to hear, well, what does that mean for you? Your investors are going to want to hear can you take advantage of that? You talk about, the ramp up period, but you've also got to ramp up to a point which you set yourself, which is a scale which you set yourself. So we know kind of where you're at with your current project, and you've said you're not averse to doing M&A if it's the right deal at the right price. Is scale going to be important for a North American producer? And if so, does that change or adjust your thinking in terms of near term versus a kind of more longer term view?
Yeah, absolutely. Scale is important. Certainly, that's one of the things we look at when we're trying to improve the return for our shareholder. There are a lot of fixed costs at any mine, uranium, copper, gold, it doesn't matter. So we want to be able to produce more pounds. We don't want to minimize the pounds. We want to maximize that production, and that'll drive our cost per pound down by several dollars a pound. And so we want to be able to do that by maximizing production at Lost Creek, but also by, in the not too distant future, we would like to be able to ramp up Shirley Basin once we've got the contracts in place to justify that. So we're doing that to try to keep our prices as low as possibly can. We're looking at making sure we've got the most qualified people possible to run our operations. We like to hire experienced people. And just everything we can possibly do to keep that cost of production down, looking at opportunities to expand production, to be able to have more contracts in place, and again, looking at those market-related contracts. So as the price does continue to go higher, we benefit from that. We're not locked in at profitable margins. We're locked in at much higher margins and have access to those much higher margins going forward. So yeah, we're in a really strong position right now as we're well into ramp up at Lost Creek. Again, looking hard at Shirley and looking hard at M&A and to see if there's any good opportunity to make acquisition for projects that we can bring into production that are quality projects. There are a lot of old, worn out projects out there that are probably not going to be in the money until you get in the 70s or 80s dollar a pound. We're not terribly interested in that. We're interested in things that the break even is more in the 40s, maybe the low 50s to make acquisition. But that's kind of our strategy moving forward is maximize production, get good contracts in place, grow that production any way we possibly can.
Right. And with that cash or cash equivalents, because we've got kind of inventory there as well, do you feel under any pressure to kind of make that work harder? Because it's just sitting there doing nothing is... Yeah, it's fine because you're not under any kind of pressure in terms of money, not capital constrained in any way, shape, or form. But you've also got to do a return on that capital at some point. So the best way, as you see it, for your investors is to do what with that cash when?
We'll continue to use some of that for ramp up at Lost Creek. Ultimately, we hope to be able to use some of that for ramp up at Shirley Basin. For years, we got virtually no return on that capital as it sat in the bank. But now with interest rates being what they are, and we're in a very secure bank, we're actually beginning to see some return from that money, which is kind of nice. But yeah, we're going to just be careful with that cash. We're not interested in going out and just burning through it. It's going to, if we make an acquisition and use some of that cash for an acquisition, it has got to be the right project. Otherwise, we're very stingy with that cash. We're happy to hold on to it and utilize it for minimal reasons, corporate G&A and ramp up, those types of things. We want to get ourselves in a position where we've got revenue incoming. We don't want to dilute our shareholders. If you take a look at our dilution compared to pretty much any of our peers globally, our dilution has been dramatically less than anybody's. And that's because we've had reliable revenue from past contracts. And that's where we want to get back to, selling into those contracts. We've got good income coming in, and so we minimize dilution and ultimately get into profits for our shareholders.
Okay. Well, look, John, in terms of your thoughts about some of the conversations coming out of the WNA in terms of how you play this, I guess you guys are going to report back to you, maybe the beginning of next week or something. It'd be great if you can kind of come back on and go, right, I think there's a kind of clear path forward for us producers in this market, because this is what we're hearing from utilities. That we'd love you to share that with us as soon as you've got a sense and a take on that one. But appreciate your time today. Thank you very much.
Yeah, thank you, Matt. It's been good to be on with you.